Okay, we'd like to continue with Chapter 4. In this chapter, we're going to talk about taxes, the economic impact of taxes. Let's take another look at our supply and demand chart at an equilibrium price of $5 and 20,000 units. That's our consumer surplus and our producer surplus areas. Let's assume that the government imposed a $5 per pizza tax. What would occur? Would the price of pizzas go from $5 to $10? Well, some people believe that's the case, but we now understand that that would not be the case due to the fact that the demand curve is downward sloping. If you increase the price, you're going to reduce quantity demanded. To be able to show how this happens, we just simply draw another supply curve that's shifted by $5. Look over there on the horizontal or the vertical axis, and we show a $5 shift, the size of the tax, parallel to the first supply curve, and that would indicate our new supply curve. The new equilibrium point would be where the new supply curve intersects with the demand curve at a point of 10,000 units. So before we were selling 20,000 pizzas at $5 a pizza. Now we would be selling 10,000 pizzas at $7.50. Let's once again cut up these areas and analyze what happens to both the consumer surplus and the producer surplus. Label each one of those areas. Can you tell what would happen with each one of these? Well, the first area we think about is area E and F. Those were both consumer and producer surplus before. Those go away. Those are deadweight loss. This area B and C represents the revenue that the government would take in on their tax. Remember, the tax is $5 per pizza. They sell 10,000 pizzas. 5 times 10 would be $50,000 in revenue that would go to the government through that tax. The consumer surplus without the tax was areas A, B, and E, and now it's simply area A. Area B goes to the government. Area E is deadweight loss. Producer surplus before was area C, D, and F. Area F is lost to deadweight loss, and area C now becomes tax revenue. The producers no longer receive that, but that is revenue that goes to the government. Deadweight loss is completely gone at 25,000. We could calculate up all of these areas and assign numerical values to each one of them. This table summarizes the before and after tax situation. The price before the tax was $5. We impose a $5 tax, but the price doesn't go to $10 due once again to the downward sloping demand curve. The new equilibrium point is going to be at $7.50, so the price will go up by $2.50. Quantity drops from 20,000 units down to 10,000 units. Total sales, we were at $100,000 before. It drops to $75,000. The consumer surplus was at $50,000 before. Now it dropped clear to $12,500, so a loss of about $37,500. Once again, remember the loss of that area. A portion of it went to taxes, a portion of it goes to deadweight loss. And we note the same situation on the producer surplus side, the same losses. The taxes before were zero. After the tax, the government did indeed collect $50,000 in new taxes, and the deadweight loss, however, was zero before, and we've created $25,000 in deadweight loss. So effectively, we have lost $75,000 in value between the deadweight loss and the tax. When we look at that again, take a moment and look at that. Make sure you understand each one of those areas. And then the question is, who paid the tax? Even though the tax legal requirement was imposed on the seller, we note here that the tax was actually fell on the buyers and the sellers. They both actually shared in that tax burden. All right, very good.